Labor Day Market Insights. Stay ahead with 5 Daily Impulses. Hello everyone, welcome to a new episode of 5 Daily Impulses, your go-to channel for staying up to date in the world of day trading. Today is a special day, it's Labor Day, and the markets are closed. But that doesn't mean there aren't important things to consider to be prepared for the next week. Let's get started. Listen up, because I'm only going to say this once. Even though the market is taking a breather today, we ain't. The market might seem calm, almost like it's on vacation, but that's exactly when we need to be on our toes. It's easy to get lulled into a false sense of security when things are quiet, but that's when the real opportunities and risks can sneak up on you. This is like a pit stop, people. You don't just sit in the car and admire the scenery. Imagine you're in a high-stakes race. When you pull into the pit stop, it's not time to relax. It's time to get to work. Every second counts and every detail matters. The same goes for the market. When things slow down, that's our cue to dig deeper, analyze more, and prepare for the next big move. You check your gauges, top off the fluids, and make sure you're ready to hit the gas when the light turns green. In the financial world, this means scrutinizing every indicator, reviewing your strategies, and ensuring your portfolio is in top shape. It's about being proactive, not reactive. The more prepared you are during these quiet times, the better you'll perform when the market heats up again. That's what we're doing today. We're going to look at the indicators, see what they're whispering, and get a head start on the competition. Indicators are like the heartbeat of the market. They give us clues about what's happening beneath the surface. By paying close attention, we can anticipate changes and position ourselves advantageously. First up, the VIX, the fear index. This little number tells us how much fear or complacency is in the market. It's a barometer of investor sentiment, and it can be a powerful tool in our arsenal. It's sitting pretty at 15, down 4.15%. A low VIX suggests that investors are feeling pretty confident, maybe even a bit too relaxed. But remember, complacency can be dangerous. It's when everyone thinks things are smooth sailing that we need to be most alert. Now, a low VIX usually means investors are chilling, feeling good, maybe sipping on some lemonade by the pool. It's a sign that the market is calm, but we can't afford to be lulled into a false sense of security. Just because the surface is calm doesn't mean there aren't currents beneath. But don't let that fool you. This market, it's a fickle beast. It can turn on a dime, and if you're not prepared, you could be caught off guard. The key is to stay vigilant, always ready for the unexpected. Just when you think it's all sunshine and rainbows, bam, it throws you a curveball. Market conditions can change rapidly, and those who are prepared will be the ones who thrive. It's about expecting the unexpected and being ready to act when the time comes. So, what do? We stay vigilant, we keep our eyes peeled for any signs of trouble. We analyze every piece of data, every trend, and every indicator. We stay ahead of the game by being informed and prepared. Because remember, fortune favors the prepared, my friends. In this game, preparation is everything. The more you know, the better you can navigate the twists and turns of the market. So let's get to work, stay sharp, and be ready for whatever comes our way. The market may be taking a break, but we never do. Our success depends on our readiness, our vigilance, and our relentless pursuit of knowledge. All right, let's dive deeper into this whole VIX thing. Like I said, it's down, which on the surface seems like good news. Investors are feeling confident, maybe even a little cocky. But here's the thing about confidence. It can make you sloppy. Think about it like this. You're playing poker, right? You've got a decent hand, feeling good, maybe even throwing a few chips around just to show off. But then, out of nowhere, someone goes all in. Suddenly, those beads of sweat start forming on your brow. You start questioning everything. That's what a low VIX can do to you. It can lull you into a false sense of security. You start thinking, hey, this market is easy. I can make money in my sleep. And that's when you get burned. So here's the deal. Respect the VIX. Don't let its calm demeanor fool you. Stay sharp, stay focused, and always be prepared for the unexpected. Chapter 3. Fear and Greed. Walking the tightrope of market sentiment. Now let's talk about the Fear and Greed Index. This index is a crucial tool for investors, providing a snapshot of the prevailing market sentiment. It helps us gauge whether the market is driven by fear or greed at any given moment. This little guy is sitting at 57% greed, which tells me investors are feeling pretty darn optimistic. When the index leans towards greed, It indicates that investors are more willing to take risks, expecting higher returns. And hey, I get it. The sun is shining, the birds are chirping, and the market has been on a roll. It's a time of exuberance where positive news and rising stock prices create a sense of euphoria. It's easy to get caught up in the excitement. The thrill of seeing your investments grow can be intoxicating, making you feel invincible. But remember what I said about confidence? Same rules apply here. Confidence is good, but overconfidence can be dangerous. It's essential to stay grounded and not let emotions dictate your investment decisions. When greed takes over, it can cloud your judgment. You might start making impulsive decisions, chasing after every hot stock tip without proper research. You start chasing after every hot stock, every get-rich-quick scheme. This behavior can lead to overtrading, where you make frequent trades in hopes of quick profits, often resulting in significant losses. And that's a recipe for disaster. Market corrections and crashes can wipe out gains in an instant, leaving you with substantial losses. Think of it like walking a tightrope. Investing requires balance, precision, and a clear mind. One misstep, and you could fall into the abyss of financial ruin. On one side, you've got fear, the paralyzing feeling that makes you miss out on great opportunities. Fear can cause you to sell off your investments prematurely, missing out on potential gains. On the other side, you've got greed, the reckless abandon that can lead to catastrophic losses. Greed can push you to take unnecessary risks, investing in volatile assets without considering the consequences. The key is to find that sweet spot in the middle, a healthy balance of caution and optimism. This balance allows you to make informed decisions, taking calculated risks while protecting your investments. That's where the real money is made. By maintaining a balanced approach, you can navigate the ups and downs of the market, capitalizing on opportunities while minimizing risks. Remember, successful investing is not about being fearless or greedy, it's about being smart and disciplined. Chapter 4. Market Analyzer. Taking inventory of the big players. Alright, let's take a look at the Market Analyzer and see how the big boys are doing. The E-mini S&P 500 is hanging tough at 57,000. The DOW is strutting its stuff at 7,900, and the NASDAQ is feeling pretty good at 32,000. Now I know what you're thinking. Edu, the market is closed. Those numbers aren't moving. And you're right. But here's the thing. These numbers tell a story. They give us a snapshot of where things stand, even on a day when the market is taking a well-deserved break. It's like checking the scoreboard at halftime. Sure, the game isn't over yet, but you can get a pretty good idea of who's winning and losing. And that information is valuable. It helps you make informed decisions about the second half. So don't underestimate the power of the Market Analyzer. Even on a day like today, it's giving you valuable intel. Use it. Chapter 5. Liquidity and Volatility. Navigating the calm before the storm. Okay, last but not least, let's talk about liquidity and volatility. These two elements are the lifeblood of the financial markets, dictating the pace and rhythm of trading activities. Without them, the market would be a stagnant pool, devoid of the dynamic movements that create opportunities for profit, or rather, the lack thereof. When liquidity dries up and volatility takes a back seat, the market enters a state of dormancy. It's a peculiar phase where the usual hustle and bustle of trading floors are replaced by an eerie calm. With the market closed, things are about as exciting as watching paint dry. Traders find themselves in a state of limbo, waiting for the next wave of activity to hit. It's a time when the usual adrenaline rush is replaced by a sense of stillness. Liquidity is low, volatility is practically non-existent, and most traders are probably still in their pajamas, sipping coffee and wondering what to do with themselves. This period of inactivity can be disconcerting, especially for those who thrive on the fast-paced nature of the markets. But here's the thing, this lull in the action is actually a good thing. It provides a rare opportunity for traders to step back and reassess their strategies. It's a moment to catch their breath and prepare for the next surge of market activity. It gives us a chance to breathe, to reflect, to plan our next move. This period of calm allows traders to analyze their past trades, identify any mistakes, and refine their strategies. It's a time for introspection and preparation. It's like the eye of the storm. In the midst of chaos, there is a brief moment of tranquility. This is the time to gather our thoughts and ready ourselves for the inevitable turbulence that lies ahead. Everything is calm and peaceful, but we know that the winds will pick up again soon enough. The market will not remain dormant forever. The calm before the storm is a precursor to the flurry of activity that is bound to follow. So what do we do with this precious time? We review our strategies, ensuring that they are robust and adaptable to changing market conditions. We take this opportunity to fine-tune our plans and make any necessary adjustments. We double-check our stop-loss orders, making sure that our risk management measures are in place. This is crucial to protect our investments when the market becomes volatile again, and we make sure we're mentally prepared for the week ahead. Mental fortitude is just as important as technical analysis in trading. A calm and focused mind can make all the difference when navigating the ups and downs of the market. Because when the market opens again tomorrow, it's going to be like a bull in a china shop. The tranquility will give way to a whirlwind of activity, and we need to be ready to act swiftly and decisively. And we need to be ready to ride that wave, baby. Embrace the volatility, harness the liquidity, and make the most of the opportunities that come our way. The calm before the storm is not a time to be idle, but a time to prepare for the exciting challenges ahead. Stay sharp, stay informed, and get ready to conquer the market. My advice for today: stay calm, review your strategies, and get ready for the week. Staying informed about indicators, even on a day without the market, gives you an advantage over other traders. And don't forget, tomorrow we'll talk about how the market might react after Labor Day. If you liked this video, don't forget to subscribe, like, and share it with other traders. See you tomorrow in another episode of 5 Daily Impulses.